Let's get down to business. What's up, Bull Run? How we doing? How we doing? All right. Yeah, we can. Let's wait for our classmates to get in. Let's go to... Alright, now we gotta... Let's go ahead and push this out to everybody. Alright. There we go. What up, everybody? Here's our graphic for tonight. Oops. All right, we'll get started here in about 2 minutes, and then people can kind of file in and get in when they can. All right, everybody. Welcome back. Welcome all. Tonight, we are going to talk about earnings. So, earnings reports. In the spirit of what we're in right now with earnings season around the corner, I figured I'd give you guys a little bit of a dive into how to prep for earnings, what things to consider with earnings, and all that kind of stuff, right? And then we'll also talk about how to read options flow and kind of keep it like an open forum type deal, if that works for everybody. So let's go ahead and get started. So basically, earnings reports are the same as Catholic confession. They only happen once in a while, usually once a quarter, and they tell investors three things: how much they made, revenue; how much they kept, their net income / EPS or earnings per share; and then how they performed versus what Wall Street expects. So let's go ahead and break this down, because the game isn't about numbers, it's about expectations, right? So key metrics to know. We have revenue as our top line. This is sales for before expenses. And why does this matter? Well, that's where the growth story starts in this case. Then we have EPS, or earnings per share. That's profit per share, basically. This is used to calculate their PE ratio. Gross margin. This is their profit after the cost of goods, pretty much. We have operating margin. This is after expenses. Think R&D, SG&A. And this measures their efficiency. We have free cash flow, which is the real money that's left over, or FCF, and then that determines their sustainability. And then finally, we have guidance, and that's the forecast for next quarter, and this moves the stock more than the actual numbers do. So a company can beat earnings, but as we've seen time and time again, that same company can drop harder than a rock if their guidance is ass. But the opposite can happen too. They can miss everything for earnings, but rip if they raise full year guidance or next quarter's guidance or whatever the case might be, right? Because the market trades the future and not the past. So you could miss EPS, you could miss revenue, but if your guidance forward looks strong, you still will have that potential to rip to the upside, right? Now, Okay, so now one thing to consider here is basically earnings reports are a bad breakup. It's not about what you said, but it's about how you said it, right? Now, let's look at the actual anatomy of an earnings report here. Because if you've never opened one, it looks like just 47 pages of pain. So there's 3 parts that you actually need. So the numbers, earnings release PDF typically that comes out. It's found on the company's investors relations site, and it focuses on top line revenue, EPS, margins, and overall guidance. Then number 2, we have the earnings call. This usually includes their 10Q plus a transcript, and you'll be familiar with the 10Q because we went over that with our balance sheet course, right? This is where the CEO can come and do damage control, basically. Listen for the tone and keyword shifts. Think words like headwinds and macro pressure. That's a red flag, basically. If you hear things like margin expansion or accelerating demand, get on the rocket ship, buddy, because we're going to the moon. Or as Buzz Lightyear would say, to infinity and beyond. Now, the market reaction. Forget CNBC. Watch the first 5 minutes of post-earnings tape. If good news comes, well, that equals a dump. Because that means it was already priced in, like the earnings was already priced, right? But if it's bad news, pump. It means expectations were too low, basically. So the expectation game, market reaction equals actual results minus expected results minus the tone adjustment. That's why it's not enough just to be right with earnings. You have to be righter than the street in this case. Now let's talk preparation, right? And I'm not talking preparation H for all of my people with hemorrhoids in the chat. But this is not a situation in the market where you want to YOLO. You want to prepare like a shark looking for blood in the water. So, our checklist here. Key levels, prior earnings gaps, VWAPs, and support and resistance areas, right? Trend direction. Were we trending up, sideways, or is the stock in a total correction zone right now? Volatility, IV rank. High IV equals initial premiums, inflated premiums, which could equal to a sell-off in this case. And then expected move, historical reaction, plus or minus the implied volatility move. So, for example, if Tesla's IV is 85%, that means the options market expects a big move. Not guaranteed direction, just guaranteed drama. So it's not saying it's going to go up or down. It's basically saying it's going to go up or down in a very aggressive fashion, right? Now, understanding the fundamentals. So you can pull these from Yahoo Finance, by the way. We have revenue growth. It's bullish if it's accelerating, but it's bearish if it's flattening, okay? For margins, what's up, Nick? If those are expanding, that means that is a bullish statement. If they are shrinking, then that is bearish, okay? Cash flow, if it's positive, that's the bullish signal. And if they're burning cash, that's the bearish signal. Debt levels, if they're declining, that's bullish. If they're not declining and they are rising, well, that's bearish. And finally, guidance. If it's raised, that's bullish. And if it's lowered, that's where the bears come to the party, right? Always check how the story has evolved. If they've been cutting prices or missing delivery targets, the sheet's patience is thin, to say the least, right? Now, the next thing is watch the flow. And this is where Investor Central Club comes into play. The flow, it never lies. And here's what we look for, right? You want to look for bullish call sweeps. These are aggressive buying ahead of ER. Sweeps represent people aggressively getting into positions and not necessarily putting orders in, but they're just willing to get in at a price, right? Put walls. This is heavy downside protection in this case, okay? Dark pool accumulation. These are quiet whale moves. So anytime we see accumulation happening in the dark pools ahead of an earnings report, we can signal that as a bullish move, because what are dark pools? Well, that's where institutions come and buy stock without necessarily moving the stock price. It allows them to buy common stock. Yeah. So, for example, Intel Corp would be something we look at on the tape. So the way you can tell if it's a sweep or a block, it's under this type here. So we can see there were some sweeps getting in on weeklies. All of our sweeps, for the most part, are bullish indicators here, right? So all of the sweeps we saw were call blocks, which should have indicated that people were bullish going into Intel. And we can see these were automatically executed. Okay. So basically, the difference between a sweep and a block is a sweep is basically saying, like, imagine a child is just basically saying, like, I want candy right now. I don't care if they're on different shelves. Just grab all of the candy you can, right? They buy chunks from multiple sellers at once across different exchanges and prices. In options terms, a sweep equals an order broken into smaller parts and filled on multiple exchanges to get filled and filled fast. So they want an aggressive, fast fill on their order, which is why it's indicated as a sweep. Usually this means urgency and conviction because they really want to get in, right? So sweeps, think of it as whales are in a hurry to get into this position. They're slapping the ask. They usually are very aggressive going into flow. What's up, Super Gal? And then a block is when someone says, hey, store owner, I'll buy every gummy bear in your shop. One clean deal, one price. In trading terms, a block is a large negotiated trade between two big parties, like think about it as two hedge funds, right? It happens off exchange in the dark pool or negotiated venue. It's not rushed. It's prearranged, private, and deliberate. Example, Apple $200 calls, 50,000 contracts at a block traded for 50 million. This could be a hedge or a reposition, right? Because if we also notice the blocks tend to be smaller than what we would get at a sweep level, right? Like we're seeing these 50K blocks, 60K blocks, 70K, 230, 200. So blocks, think about it like big money is moving silently, and these are usually hedges, portfolio adjustments, or they're going to be longer term plays, okay? So sweep, whales are panic buying candy, aggressive, short-term directional. Well, so it's going to be a type. It's going to come through like this. So it's going to say block, or it'll say sweep as the type, right? So like these are all examples of, here's a block trade right here for Intel. 77K, $45 calls, 99-cent average, right? So it's not like a block is going to be a big set of orders all the time. It's just the type of order that it was. So it's either a sweep, which is, again, whales panic buying everything they can, meaning they just want to get in now, or it's a block, and that's where they're a little more deliberate and going to take a little bit more of their time as well. Okay? Exactly. Yeah, so if you're looking, typically sweeps are going to be these people have some serious conviction if they're buying a sweep, because it is an aggressive play, meaning they don't care when they get filled. They just want to get into the play right now. A block is something that has been set up and is usually an automatic execution based on price as well, or a multi-leg floor trade as well. Oh, whoops. That's why. Speaking of conditions, yeah, so basically think of it as sweeps are aggressive, like take my money. That like Fry meme from Futurama. Like, take all my money now. Now, this is the conditions tab, okay, on our far right. You normally don't see this when we're on flow, right? But this is just to give you guys some ideas of what this stuff is. So first things first, automatic execution. These are your regular trades filled automatically by the exchange. No special handling, no manual broker in this case. It happens on screen electronically between a buyer and seller, matching prices, right? And it usually is retail or an algorithmic trade of some kind. So this would be auto execution. These would be as well. Basically, the translation of this, these are going to be fast, normal, nothing sneaky, just clean execution. Example, someone buys Tesla 250 calls directly off the ask. It'll show automatic execution, right? Next up, we have our multi-leg auto electronic trades. Those are what come up next. Now, multi-leg trade like this, for example, these $37 puts due for 1024. this involves more than one option contract at the same time, like a spread, straddle, or iron condor. Auto electronic means it was done by an algorithm automatically, not manually negotiated in this case. And this is an option strategy trade, not a single call or put in this case, okay? So an example, someone opens a bull call spread buying Tesla 240 calls and selling Tesla 260 calls simultaneously. Both legs get filled electronically. So if we take the buys off here, we can see that, for example, okay, here's one. So here would be an example of a multi-leg electronic. We can see they were buying calls at $43, or the $43 strike price, but they were also selling calls at the $42 strike price. Same expiration, around the same order size, the same details in this case. Okay? So is this multi-leg making a little more sense now? And this is just for multi-legs, by the way, so let me know if this is making sense to everybody. So one way you can look at this too is this is where they see psychological resistance potentially at $42, and that's why they're going to start selling calls, right? Hey, what the hell-y? Let's go, Nick. 5-stream run, my boy. Soon you'll be up there with Super Gal and Loaded. I think this is Loaded's 11th or 12th in this case. This is Super Gal's 10th at this point. Yeah, I would say so. These are like, those are going to be your auto executions that are going to be kind of the high conviction trades. Like an auto execution is going to be high conviction, but we still have some more conditions to go through as well. So we can see some more examples of this as well. But you can think of this as when we see calls being sold at a similar level, we can think of it as the psychological resistance that is being built, especially if we see the same strike multiple times, right? Follow me so far? Okay, cool. So think of a multi-leg auto electronic trade as basically a strategy trade done automatically. This is not a simple YOLO sweep, okay? This is usually where your block trades are going to come into play. As we can see here, block, auto execution is a sweep, multi-leg, block. Is it making sense? You guys kind of catching the patterns here? And that is why I'm explaining all this so broadly, by the way, so you have the opportunity to like see these patterns for yourself and kind of come. Because if I just bring you to the conclusions, then you're never really going to learn. But if you're able to come to that conclusion on your own and you're able to see it in your own way, well, then you're never going to forget it, right? So now, next up, we have a multi-leg cross. So for example, it's going to be one of these guys, right? Sold calls $45, 498K for 12/19 of 2025. Now, a cross means one party, like a broker or a fund in this case, matched a buyer and seller internally before sending it to the exchange. Multi-leg means it was a combo trade, like a spread, and usually institutionals are in this. So it's two big players agreeing on a price privately, then reported to the exchange. Translation, a big fund-to-fund deal, likely hedging, not speculation in this case. So we go back to just our buys only. We can see this is a multi-leg cross to 20. Another multi-leg. Where's another one? Here's another no. Let's just. So these are a little less common. Now, multi-leg floor trade, similar to a multi-leg cross, but it was executed on the exchange floor, aka a human broker handled it, not an algorithm. Okay, it's rare today, and they're usually large, old-school institutional orders in this case. Think hedge funds, pensions, or legacy traders using manual brokers. So think of it, multi-leg floor trade is basically a big manual deal that was executed on the floor. It's less about the speed and more about precision or privacy in this case. Then we have a stock options cross. It's a cross trade between stock and options simultaneously. Usually it's part of a delta hedge or conversion / reversal strategy, right? So it's used to keep positions delta neutral or manage exposure in an already existing position for that stock. Okay? So these $40 calls would be looked at that for 116.26. That would be an example. And you can tell it's an existing position because it's minimal volume against 113,000 in open interest, right? Meaning we have dealers who are expecting price to be at these contracts to be in the money by 116 of 2026. So think of, let's review, okay? Automatic execution like these, $44 calls, $50 calls. These are, hey, shout out to Seathles99 for the follow. That puts us at 872. By the way, guys, we do still have our sub goal going. We're trying to get to 30 subscribers. We are 6 away currently, just as an FYI. Now, automatic execution, these easiest way, normal trade, computer matched it fast. Who's doing these? Well, everybody does these, okay? A multi-leg auto electronic trade is 2 or more trades done at once, like a spread, and these are for your strategy traders. And again, our example would be we're seeing calls being sold and calls being bought. And same condition, same amount of contracts, around the same order size, 3,208, bought on both. The only difference is that premium juiced those cells up a little more. The multi-leg cross we're looking at, again, those are rare, so I don't know if I'll be able to find one. Oh, here we go. So like these would be puts, $20 for 1/16/2026. This is a big fund matched its own buyer and seller quietly, okay? And mainly institutions are taking those trades. Our multi-leg floor trade, this is a human broker that executed the trade on the floor. So not a machine, not an algorithm, but Bill Polanski from Iowa, who now works on Big Wall Street, is the reason for that. And then we have a stock options cross. So they traded a stock plus options together. And this is usually market makers / funds making those trades, okay? Okay, perfect. So with Intel today, we can even tell in layman's terms and in simple terms, we have a big difference of calls coming in versus puts. We had 7.5 million in calls against only 2 million in puts. If we look at Wave X as well, we can see that at about, what the heck? Let me reload this. So at about 1501, so about 301. Yeah, we can see it about 308. We're seeing a huge spike and surge in calls. And then again, right before closing bell, and about 4 minutes after closing bell, we just see a huge spike in calls and call activity across the tape, right? So that gives us that bullishness in this case. So this right here is giving us our bullish bias in real time. And the first initial dip, and we see puts essentially falling off the map at about 11:27 this morning. Make sense to everybody? Now, this is the fun part of earnings. You've done your homework. Now, how do you actually play this? Well, you have a lotto directional play. That's why you'll see a lot of people be like, hey, earnings lotto, Intel $45 calls for the week usually. But you want to buy calls and puts when IV is low and the flow is clear. So in this case, it was so that's just your aggregate. So that's just basically taking the calls versus the puts and then putting a direction on it. So obviously if you have more puts being bought than calls, we would see a red aggregate. If we see more calls than puts, we would see a green aggregate, right? So the goal of a lotto directional play is to catch a surprise move, but the risk here, and you'll hear this a lot, IV crush will kill your premium if you're wrong on timing, even if the direction's right. That's why you'll hear people be like, "Oh, I was a week early," or I went a week too early. I didn't go far out enough. I didn't buy enough time, right? Now, B, we have volatility crushing plays. We don't. Yeah, we'll just go over post earnings playbooks. So, post earnings. Really, when it comes down to your strategy, it's just going to come down to like, what are you seeing in the flow, and does that match your bias, or do you understand why your bias might be wrong? Okay. In this case, we could see that if you were bullish going into Intel, well, the flow pretty much confirmed that bullishness, right? Now, there are some post-earnings moves here, right? So first we have the gap and hold. This means the stock opens up and holds 50% of its move, and you basically are going to ride the trend, right? So like Tesla, beat earnings, right? But didn't have great guidance. So we see here yesterday this was the move on Tesla post earnings. So the move, it touched a high. If we go ahead and bring this box down. Oh, wait, no, it even went higher. So it touched its high at 443.22, and its low point of earnings was basically 417.37. So then we have our after hours. So most likely we had some dark pool sell-offs and accumulation. And because it was Tesla and they had, well, it's not shocking either, because you have to remember, Jim, if you looked at their balance sheet, they aren't in debt. If they do want to expand, they can go into their own cash reserve without hurting their stock price too much. And if we go ahead and look at flow for Tesla this week, going up to earnings, it was bearish going into it, but then, right, so we had 118 million puts against only 67 million calls. So shorts got paid, but they had to get out right around this level here because this was the pivot point, right? Like, ironically enough, it made the good move you'd want. It touched its pre-market low, held, and then kind of just racketed off immediately. So we had a nice $28 move today, it looks like. Yeah, almost a $30 move. So this would be considered a gap and go. So it gapped down again, and then just went, right? Yeah, I can revisit MU. MU's earnings was when? Their last report, September 23rd. Okay. So MU's pattern so this was MU's earnings. So it touched our box here. So its earnings move would have been technically this. You need to make sure this box is like accurate. Okay. I forgot I have to click off. Okay, that's accurate. So this was basically MU's post-earnings move, right? I mean, not really. It was in this case, it would be a gap and fade. So the stock popped, right? So we had our nice pop here in our first direction. And then it kind of faded off into that next session, right? So with MU, it was essentially a gap down, and then it was a fade. Oh, meant Tesla? Yeah. So Tesla would have been a gap and go. Oh yeah, no, you're fine. But yeah, that would have been a gap and go on Tesla, and that would have been the easiest way to describe that, right? And then Jim, for your MU, it would be a gap and fade. So we saw the stock pop and then essentially just get sold off. Because it could have technically been considered a gap and hold because it did hold 50% of that move, right, when it opened up in pre-market, but then we saw it fade down, right? Make sense? And then to Super Gal's point, this would be a gap and go. On Tesla. So we see it gap down into this demand zone. Potentially. So with Intel, we could potentially see one of two things, right? We could see it, if we want to see it hold 50% of this move at least, we want to see a 50% hold of this move. So we could, in theory, if we just use like this box, so our move is what? This is our post earnings move right here. So we could see price revisit into this zone. Yeah, exactly. So we could see it play down into this zone and then bolster back up. But again, we want to see it hold like 50% of this move. So we could see it revisit like 38.99, but then see it move back up to these. So let's say this is our earnings high, basically. Or we see the opposite, where we see price go up to that $45 level, right? Like we'll say in this zone, for example. And then we could see it fade. Like a degen, I took weeklies on Monday, so I'm definitely selling it open. But does this make sense to everybody so far? So we have our gap and hold. 45, I'm selling, yeah, 100%. Okay. So we have our gap, we have a gap and hold, we have a gap and fade, we have a gap and go, right? Tesla. We have the gap and fade. That would be our MU example. Let's see if we can find a gap and hold. Then we have volume confirmation. So high volume equals a real move, and you're just following flow at that point. And then you have flow reversal. So puts flip to calls post ER, and this is big money buying the dip. That could also be a Tesla, because if we go and look at our Tesla flow for today, so we see it was super bearish, right? But today we had a flip. Does everyone see that? So 1022 to 1020 to 1022, what do we have? Bearish. We have a bearish bias going into Tesla, right? And then today, after earnings, what happened on the 23rd? We had a bullish flip. So we see calls outweighing puts in this case, 67 to 27, showing investors wanted to step in and buy that dip on Tesla. Think of it like this. Post earnings is pretty much like the after party. The real money, i.e. has institutions, hedge funds, big wigs, they're going to be the ones coming in with the real money once the tourists, aka retail, leaves the market, i.e. gets shook out, whatever the case may be, right? Let me know if we are ready to move on or if we want to go over some more. So now, let's go ahead, like Ariana Grande saying, thank you, next. Oh my God. All right, so now let's talk about some valuation metrics, okay? So we have PE, price/earnings. This measures how expensive the stock is, okay? We have our PEG. We went over this in our balance sheet class, by the way. This is your price divided by earnings plus your growth rate. And this adjusts for growth, and this is your fair value test. And then you have PEGY, which is price divided by earnings plus growth plus yield. So it basically just adds a dividend impact if the company has an actual dividend, right? So Tesla's PE of 75 meant it was priced for perfection. That's why we most likely saw a sell-off, right? If earnings are good, but they weren't God tier, the multiple compresses, and boom, we saw nothing but red candles on Tesla, right? Now, there are some macro overlays as well. So before trading earnings, you'll always want to check these things. Fed policy, rate cuts, or hikes affect the valuation of that stock. CPI, PPI, jobs data. Well, in this case, jobs data doesn't matter because, well, the people who run that are currently not working, and that department is not open. But in this case, CPI, PPI, that's going to affect consumer spending stocks in this case. For the sector rotation, are semis hot, or are people money moving into defensive stocks? Like, are they moving money into defensives, or is everyone buying semis? So you also have the narrative of, like, what's the hot kid? What's the hot popular kid doing, you know? Then we have geopolitical risks, tariffs, war, trade wars, trade deals. They all influence risk appetite as well. Now, earnings doesn't exist in a vacuum, unfortunately. If CPI drops the same week NVIDIA reports, you're not trading just NVIDIA. You're trading macro sentiment disguised as a semiconductor, right? So let's get into the boring stuff. Risk management, okay? If you don't manage risk, the market will manage it for you, and brutally. That's why you'll hear everybody say, oh, I get destroyed during earnings. I get tanked during earnings. Well, never YOLO full size into earnings. First things first, right? Always use spreads or limited risk plays when IV is elevated or high. Don't fight the flow unless you have, like, very true conviction. And this is, again, why you don't YOLO all of your money into earnings plays. Trade smaller if the market's directionless heading into earnings. So if we don't have a clear direction, play small. Because the moves are going to be volatile, the payday will be good even if you play a small size. Not every trade needs to be a 10K day. And size your trades for survival, not ego. So as me and Lo say to each other, we trade to live another day. You want to trade so you have enough money in your account to continue trading the next day. You do not want to blow everything up in a single day, because then that's when you feel like an idiot and don't feel like you even know what you're doing at that point. And we've all been guilty of it before. You can't get rich in one trade, but you can go broke on one trade. You can blow your account up and have to take time off one trade. So IV is implied volatility. So let's go find some examples of high IV trades. So here's IV from today, for example. So think about, oh, what's super high? I mean, anything like when you want to start paying attention, it's like anything above 50%. So 50 to 75% is going to be considered elevated IV. And this is traders pricing and movement on the stock. So like high IV here, like this beyond is crazy. 795% IV. So here, we'll pull some live examples here. So basically, what do I take into consideration? Yes, so high IV means you can get IV crushed. What do they take into consideration? What do you mean, what do I take into consideration with it? I mean, that's where it gets risky, and that's where risk management comes into play. So, okay, let's go ahead and break this down of like what to actually take into consideration. So high IV equals high fear or high hype. We're always going to see this during earnings reports, economic events, rumors, catalysts, or mergers, and macro stress. And then obviously our meme stocks, right? We have 700% sitting in those beyonds. That's just crazy. Oh, chasing anything above like anything like above 75 to 100%, I would say is like chasing at that point. Because you have a higher chance of being crushed, basically. Oh, on the chart? Oh, they're even higher than that. Look at these. On the weekly, the $4 are sitting at 795%. The lowest one was 270%. So like to me, you would just be chasing beyond at this point. And if we go look at Beyond's chart, it's pretty much playing out how I said it would. Like, this was going to be the battleground for price pretty much. So we would have wanted to see a bounce here to see it to continue go up. But I figured we'd see price come down into this zone and kind of hang out under the bottom line of our demand. Because this was pretty much my flip point for it. There's a short interest report tomorrow. I don't know. I don't know if there's a short interest report on that. So think like high IV before the event, premiums are going to explode. So options cost more, but the risk to reward drops. After the event, that's where you'll see that IV crush. That's where premiums absolutely collapse on themselves. Even if you're right on direction, your option can lose the value on it, right? And then during panic selling, IV spikes sharply. Smart money sells volume, retail buys the fear. So you buy Tesla calls for $4 before earnings, right? Stock goes up 2%, IV drops 40%. Your call is now worth $2.50. You were right, but you lost money because your IV in this case got crushed. Now, when IV is high, not all flow is equal. So if we're seeing a sweep, for example, these are going to be our short-term calls and puts. This is chasing volatility, speculative traders or short-term event bets, right? For blocks, these are going to be longer dated. Institutions repositioning, hedging, not gambling in this case. Sold premium. So if we see the sells, think of it as condors / straddles. These are volatility sellers. Best IV will collapse post-event. So they're betting that IV is going to collapse post-event in this case. So we can see here, this was probably a multi-leg floor trade. Or no, this is an auto execution. So this is retail. They were buying and selling calls almost at the same time. Wait, what? The Ronald Reagan Foundation has just announced that Canada fraudulently used advertisement, which is fake, featuring Ronald Reagan speaking negatively about tariffs. Tariffs are very important to the nation's security and economy of the USA. Based on their egregious behavior, all trade negotiations... Wow. Wow. Wait, what was that thing I was looking at? Shit. What is it SPXU? How do I see the overnight chart on SPX? What's that ticker again? SPX 500. Okay. Our SPX chart is so on point. Holy shit. Holy shit. I drew this out so long ago. All right, so Rolls. Yeah, they mentioned that in his press conference earlier today, that they asked why he decided to pardon the Binance guy, and he was like, "Oh, well, that was the Biden administration who wanted to get him in trouble. I was told by some close friends of mine that he's a good person, so that's why I decided to pardon him." Because in his words, he has no problems with the guy. So when it comes to Hy-Vee, it's going to be, I know, it's going to be a long ass 3 years. I think you just pardoned. Oh, no, you're fine. You're fine. So next thing about IV, timing is everything. The pre-event. So in pre-event, high IV equals expectations are already priced in. Don't chase expensive premiums. Wait for IV crush opportunity or trade spreads to offset your cost. During the event, watch your live IV reaction. Flow plus price plus IV dropping equals your premium basically evaporating in thin air. And look for post-event flip flows, puts to calls, i.e. Tesla. Then post-event, IV normalizes. That means cheap entries for follow-through moves. Smart money will reposition here for the next wave or where they see price headed to next. Exactly, IV flush. So what to check before entering a high IV trade? Well, IV rank / percentile. Is this IV actually high for this ticker? Or are we just being sensitive? That's really the question you need to ask yourself. Yep, flush on Tesla, but we also saw a flip from bearish flow on Tesla to bullish flow today, right? Like we could see a lot of people were selling puts at open. A lot of put selling. And ironically enough, if we go and look at Tesla's chart, look at where it bottomed out at. 413, but we had support for him at around 419. And we saw puts being sold at 420, 412, and 415. So that was a sign that dealers did not see price. This could be looked at as support, basically. So this would be looked at as support. Okay. Now, historical IV range. How does it compare to past earnings / events? Event date, what's causing the spike? ER, CPI, FOMC? Is it a meme stock? Who knows? You know, that's where you got to do a little bit of digging and a little bit of homework. Expected move percentage. Is it realistic or is it overblown? The expected move is going to be in this column here, minus 1.2%, up 0.01%. It's easier to see it on buys, to be honest. So this is just telling you what do they expect the move to be for this options contract to basically be in play. volume versus open interest. Are traders opening or are they closing? Now, typically, when you see like these unusuals, we will see volume over open interest, and that's why it gets marked as unusual. These are usually fun plays to get into just because that volume will typically flip into open interest the following day. And the reason that happens, because this is like a key indicator as well, because this is going to dictate your spread, right? So if you have volume, open interest, and crazy implied volatility, IV, then your spread's going to suck probably, and you will get IV crushed at some point. And that's when you'll see options contracts go from like their 0.40 to 0.01, and you're just like, what the hell? And it just keeps going back and forth. Now, let's talk about let's see. So we got high IV covered. Let's get back. So basically, this is the recap, and then we can kind of just keep it as open questions after this. Preparation plus flow plus psychology equals profitability in this case. So pre-ER, we're looking at setup and sentiment. We'll use Investor Central Club flow. We'll use and basically trading view. The night of ER, well, we're looking at reactions and guidance. So watch the tape, IV rank, and then we want to watch for tone coming from our guy, right? The CEO, the CFO, whoever's going to be leading that conference call. Netflix, for example, great example of of a call not going very well and seeing a fade essentially. And then post ER, trend and follow through. Look for flow reversals and volume confirmation to enter your plays confidently. Now, the goal of this is you don't want to go gambling into earnings. You want to understand what is the sentiment, expectation, and positioning. Because that's what institutions do. They're not going in and just buying contracts. Like the best play on Tesla for earnings was to play the pop and go. Seeing this bullish confirmation this morning would have given you, like if we look at the tape, we can just see nothing but calls being bought, basically. Oops. So if we take IV off, we can see a litany of call buying starting to hit the tape from 9:49 to about 11:03. And that would have been your bullish confirmation, and that would have been kind of our flip point for Tesla. We see some calls being bought. Some more calls being bought at the bottom. Okay. So that pretty much sums up how you can prep for earnings. Except you can be a degenerate scholar from the University of Free Wi-Fi Radio in this case. You don't chase, you anticipate, and you don't pray, you prepare. That is the best playbook for earnings. And when the market overreacts, well, you won't be shocked. Because why? You prepared. All right. So now, this is pretty much just an open session at this point. What do you guys want to dive into? What do you want to talk about? Let me know in the chat. Are we good on earnings prep? Anything we want to go over more for earnings, by the way? So anything else you want to go over tonight? No problem, Super Gal. Longer term positions using options flow. Yeah, so for longer term positions using options flow, that's really going to come down to one, do you have a thesis in mind, right? So, I don't know. Okay, so I'm not a good person I'm not a good person, bruh. Okay. So I'm not a good person. How do you estimate option contract prices? I mean, the easiest way is you can go into your Robinhood or you can go into Webull, and then you can kind of play around with where you think price could go, and it'll tell you what the cost of that contract would be. So simulated returns will usually be your best friend. You just throw it on your watch list, and then you can go through the chart, and it'll tell you what price would be of your options contract depending on the price of the stock, right? Or the option premium chart. I mean, they're not always 100% accurate because you're going to have to take into account IV and all that kind of stuff. Here, let's do... Yeah, exactly, twin. Yeah, that would just be like an options. I think they have like options contract calculators where you can input all that and it'll kind of project price for you. To Twin's point, the option premium chart will help as well with that. Yeah, no problem, man. Jim wants to go over longer term options positions. Let me just type this out. I'm trying to think of like a good company to use as an example. So for longer positions, let's go ahead and talk about that. BA, since chemo's in it. All right, cool. Let's do BA. And we will use the month of October as our example. Okay, we'll go even further back, I guess. We'll go to the beginning of August to current date. All right, let's talk about some BA and how to deal with longer term positions. Oh my God. Let's see here. So what's the best way to go about this? Ow, my ear hurts. All right. Hold on. Let me go pee real quick. I'll be right back. Potty break. Let me turn my mic back on. So, basically, long-term trading is, think of it like being an options trader, except you kind of want to have a retirement plan, right? Because at the end of the day, trading is a lot like dating. You're in, you're out, you're checking your phone every 5 minutes to see if they've texted you back. Positioning, well, that's basically marriage at that point. It's conviction, time, and most importantly, patience, right? The biggest mistake retail makes is basically thinking that playing scalps and zero date to expiration plays, but this can also be used like Investor Central Club to see quarterly rotation signals, okay? So trading versus investing mindset. Trader, they're thinking in terms of hours and days, right? They're thinking, okay, the 4 hour, like I need to see in an X amount of time, X amount of a return to justify me making this trade. Think their focus is going to be mainly IV, flow, speed, and sentiment. And usually we're going to see short dated sweeps. Now, position builder, these are where you're going to buy weeks and months. In my opinion, more so months. Let's go to premiums so we can see our big orders. So the big thing here with long terms is you're not chasing noise, you're tracking whales. And if you track the whales, you'll notice they're always playing out the long game. So like since August, these are the two biggest premiums that we've seen. 215s, 240s, and 210s, right? So one, you want to see the smart money theme. We want to see institutional alignment over weeks or even in some case over months. So with the data we have, we want to look for repeated block trades. So meaning trades that are at around the same strike for the same expiration. Okay? Similar strikes, similar expiration dates. So if we see a bunch of 240s going into Q2 of 2026 and we see a lot of OI in that area as well, we can assume that the market and the hedge funds expect price to be at that level in that time frame. Make sense? Then we have rolling positions. This is going to be your same strike, new date. Also heavy dark pool prints, confirming accumulation as well. So that's where you also would look into the dark pool. And we can see here, they've been quietly accumulating BA again this month. They didn't. August 5th, August 14th was the last time that we saw some accumulation with almost 120 million. Yeah, like 128 million. And then up here, we see 74 million being bought. So that would be your dark pool confirmation for accumulation of BA starting again, right? And we know that these orders are most likely the same, coming from the same place because similar cost, similar quantities. And then we would look for sector clustering as well. So semis, energy, defense, biotech. So if we see BA going up, we would also want to look for what are the things that BA plays into, and is that also getting bullish flow as well? And you'll have your own opinions on what you like to look at for that. But you're basically comparing that whole sector to see, okay, is BA just bullish or is the whole sector bullish? Because that can just give you extra confirmation for that move you're looking for in that options contract, right? Now, next thing is we're going to focus on expirations. We want anything that's 6 to 12 months out. Institutions aren't out here scalping weeklies. Best believe that, sister. They build around catalysts and events. So they're playing these contracts into an event or into a certain market catalyst that they're expecting. Longer expiries, think leaps, often reveal theme traders. So what to look for? Size? Well, it's going to be greater than $1 million in a single trade. Expiration is going to be about 6 to 12 months away. The strikes are going to be 10 to 20% out of the money. So expected move. Right? 10 to 20% out of that money. And then volume is going to be over open interest, which means this is a fresh position. This is a position they're just getting into because the volume is greater than the open interest. So who here has been on a stream where I say unusual contracts are my favorite contracts to track? So the reason why I like unusuals is because we're going to see fresh positions. Supergal has, Loaded has, I know Jean has. If you would say, basically everybody is, or if you ever watched one of my YouTube videos, I talk about it as well. Now, what to consider here is we know these are fresh positions because 20,000 open interest against 6,000, 4,900 against 500, so on and so forth. Then other unusual prints. Okay. Yeah, we can get into this right now, actually, and then kind of like move back into our long-term discussion. But this is like a huge key for me. All right, so we'll go ahead and talk about next what makes unusual positions better once we kind of get through. I only have a couple more points on this like open floor or long-term options deal. So again, we're gonna focus on those expirations that are 6 to 12 months out. Number 3, we're going to watch for flow stack patterns. Flow stack are multiple trades building a position in layers over days and weeks. This is how funds scale into size. Signs of a stack. We're going to see the same ticker and different expirations and strikes. Okay? All bullish or all bearish. So it's not going to be like, oh, they bought calls one day, they bought puts the next day, they did this. No, it's going to be one common theme you're going to keep seeing. And then we're also going to see a growing notional of these positions over time as well. Increasing OI is confirming that those positions are still open. GG, guys. Good night. Hey, good night, twin. So that's your whale quietly loading the boat. And that's your first signal. Then we have dark pool confirmation. Dark pool prints show where real stock is being accumulated. If you see call flow plus dark pool inflows, those are institutional buying opportunities. If you see put flow plus outflows, that's going to be your distribution and unloading. So flow without dark pool support is just speculation. Flow with dark pool confirmation equals conviction. And mind you, it doesn't have to be that exact stock necessarily. It could be a situation where you see BA being bought and then you see a bunch of airline stock being bought in the dark pools. Or you see any type of other play that BA plays into being bought in the dark pools. That can also give you confirmation. Now, spotting the rotation early, that's the nice part about options flow. You're able to do that as well. So new sectors are starting to line up, i.e. energy, uranium, defensive, reallocation of large cap flow. So QQQ, instead of them buying that, they're now buying XLE, XLV, one of the X's basically. And then macro catalysts aligning, think oil, interest rates, tariffs, all that kind of stuff. So when SPY put blocks and oil call blocks hit at the same time, that's not random. That's just a rebalancing at that point, right? So now, what would be the plan for longer term plays? Well, first things first, identify institutional alignment. So find the sector or ticker. Confirm that with dark pool inflows being bought during that time period as well. Wait for technical confirmation. Think support hold, breakout retest, and then scale in with a mix of stock plus longer dated calls. And then finally, you want to monitor that open interest growth. Stay while the whales stay. That's why when they come on stream, the first thing I'll tell you is, well, what's the open interest? Has it changed? Has it increased? Because if it's increased, that just means there's more conviction, right? If it's decreasing, that means the whales are getting out, okay? So this is why Investor Central Club gives you a massive edge over retail. So one, you front run analyst upgrades. Whales often buy months before news drops. By the time analysts upgrade, institutions are already 50% in their position at that point. Two, you ride the same trends as funds. So they don't guess, they rotate with data. Rates, liquidity, and macro themes, think AI, defense, uranium, biotech, microchips. You see the footprints before they announce positions in their 13F filings. And then three, you avoid emotional trading. So when you follow the data from options flow, you're not chasing candles at that point. You're tracking conviction. That turns your what could be volatility into solid opportunity, right? So retail, think about it like this. Retail reacts to red days, and whales are going to add on red days. Now, what are some of the benefits of building longer positions, right, Jim? Well, we have time leverage. Theta decay is slower on leaps, less stress on the day-to-day noise, right? We have compounding gains. You can scale into winners and you don't have to flip them, right? And then psychological calm. You're playing macro, not micro. So you're a lot less emotional or stressed out about data coming out. Then we have the flow alignment. This lets you see real direction of institutional conviction using Investor Central Club. Smarter tax efficiency, longer holds equals a capital gains advantage as well. And then a higher hit rate. You're aligning with smart money trends and you're not playing into FOMO bets like Beyond, right? So here's an easy way to put it for the chat, okay? Trading Investor Central Club flow short term is like riding the wake of a whale. But following Investor Central Club long term, that's like swimming behind it and eating what it eats. You're not front running retail anymore. You're shadowing the actual big money rotation when you're putting out those longer term positions. So now let's go ahead and dive into what makes some unusual options more valuable and more, well, essentially just better to track, right? So we've all seen $10 million call blocks and was like, this is going to go crazy. But guess what? Not all unusual activity is created equal. So unusual doesn't always mean bullish or bearish. It just means different than the normal activity. Okay? But here's the catch. Sometimes just hedging, rolling, or even a mispriced spread. So before you think I'm going to throw my whole bank account at this, you got to ask why this trade and why now? Like, why did they make this trade right now? So for example, let's look at the Tesla 370 puts due for 6/17 of 2027 with a $38 million notional, aka premium. That's massive size with low IV on a multi-year duration, right? That's not a trader betting Tesla crashes tomorrow. That's likely a structured hedge or long-term protection trade in this case, right? So this we can look at because of the expiration and the notional or premium. This can be looked at as a hedge and protection against a much larger position. Does this mean that this is going to print and be 10,000% next week? No. Because remember, look at the time, right? 6/17 of 2027. So now let's talk about what separates smart money conviction from choppy noise. And here's what to actually look for. By the way, is this making sense so far? Because we're just getting started. Okay. So big size means absolutely nothing if you don't have the context, right? 10 million in SPY is just another Tuesday. I mean, let's go ahead and look at what was traded on SPY just today. Alone today, SPY saw 43 million in flow. And it was like a flat day. Yeah, it can be. I mean, Tesla, Meta, anything that's a high volume ticker, it can be harder. But that's where you have to look at, like, why this trade, why now? Like, think about it like that. No, it's not harder to know anything. It's just like you have to take into consideration, like, why are they making this trade right now with what's happening with the stock? Like, what would be the point of this? And then use, like, common sense in terms of, oh, well, this could be a hedge against downside for the long term. Like, kind of like that Tesla example we just went over. It would be like, why that trade, right? Why that trade? Now, 10 million in SPY, that's nothing. But 10 million in SOC, a small cap like IWM or anything, is a massive statement. The rule is size matters relative to average flow and market cap of the stock. So like Beyond would be an example, right? If we see massive money going into Beyond, it's not a huge stock right now. It doesn't have a crazy market cap. So $1 million dropped on a position in Beyond, that's going to raise some eyebrows. 2 million, 3 million into it, that's going to raise some eyebrows, right? On a stock that's only trading at like $3 a share right now. Cool. So size versus context. Everybody got that? Yep. What's up, Jim? Yeah, so if we look, yesterday's premium on SPY had 38 million, right? But yesterday was also a low volume day, it seems, because that was our top trade, which was SPY. But the point, Jim, is like if we saw 10 million in SPY, that's just another average day, right? Like that's nothing to like. That's not making a statement of any kind when, let's say, we're used to seeing 30 million plus being traded on SPY daily on a daily average, for example. And typically when we see Trump speak, those are days where we're going to see lower volume on SPY, but we will see kind of the post reaction the following day. Yeah, exactly. Like 10 million on SPY versus 10 million on UPS, that is a very big difference, right? So now strike selection. So conviction flow usually sits 10 to 20% out of the money. Exactly. WaveX, that's where we can use WaveX, and that comes in clutch. So we should expect the market to be red tomorrow based on Trump's Canada Truth Social tweet. Most likely, yes. Most likely, yes, we would probably see a red day tomorrow, unless we get some kind of new, because it's Trump, so he could say something else in the next 3 hours, because this dude truths at 2 a.m. where he changes his mind, right? Trump plus CPI, yeah, we can expect a red day, and we're expecting CPI to be up 0.2% year over year, coming in at 3.1%, which is up from the 2.9% that was reported in August, right? Meaning that tariffs are starting to take an effect, so it is ticking inflation up. That's why Goolsby is in the corner freaking out right now by himself, because he's the only one that thinks, he's like that wallflower who's like, I bet no one else knows that we're cutting rates into stagflation right now. I bet nobody knows I'm the only one who doesn't want to cut rates into stagflation because I'm cool like that. Yeah, I know. That's why I wanted to look at the SPX 500. But it's also within our range that we drew out. So like this is my SPX range. And we could even say it's a little higher up. In here at this point. Nobody buys it anymore. Yeah, nobody's buying it. Everyone's understanding that, like, he could just walk that stuff back easily. Up 0.1% on that. It's crazy. So conviction flow is at 10 to 20% out of the money. We're looking at the money, so high delta used by funds to express directional conviction, and not crazy lottos. That's retail or hedging noise. So think of it like, No. So think of it like this. The Tesla 617, 2027, 370s, this is a controlled insurance bet. And then Carvana, the 1219, 2025, $400 calls, this is going to be equal to aggressive speculation. Likely it's part of an institutional recovery play. Now, mind you, this also came in during August, and it was at 346. We can see that Carvana is now at 341, but they were most likely able to take profit around 385, or yeah, because that takes us into July. So they most likely bought in this range, and we saw almost we did see 400 before we saw a sell-off, right? So that was an aggressive speculative play in this case. Shorter dated, high premium on a stock like Carvana. 15 million, 400 strike, December expiration of this year. Fresh position because we have volume over open interest. So we know that this is something they're getting into with high conviction, not adding into, right? Now think about it like this. Longer expiration dates equal conviction, and short dated sweeps are where you are going to see a little more speculation. The blocks and sweeps, that's where those come into play. Blocks, conviction. You throw a long date in there too, that's very high conviction. Right? Now, think about it like this. Expiration date, 0-day trades to 1 week out, scalpers, and intraday momentum. That's all that's representing. 1 to 3 million, those are event-driven or tactical trades in this case. 6 months to 2 years, institutional thesis, or a hedge. FSLR January 2026 calls and Google January 2026 calls, those are going to be conviction plays. Someone is betting long-term upside, not just chasing the everyday candle, right? What the hell? No. That was weird. Well, my phone's definitely listening to me. So think of it volume versus open interest. As I mentioned earlier, this is your confirmation filter. So if volume is over open interest, this is a new position. If open interest is over volume, then that's an existing position / a roll. So SPY puts with 200K volume But 18K OI, that's fresh money coming in. That's the stuff that you want to start tracking. IV behavior. If we see rising IV, the market is bracing for volatility at that point, right? If we see falling IV, premiums are deflating, and we see a calmer market. And if we see low IV plus large flow, that is a stealth accumulation occurring. They're basically sneaking into these for cheap. Think the Apple 116.26 calls. Where are those? Here we go. So the 116.2026 calls, 8,030,000 volume against 7,000 open interest, 286, giving us an $8 million premium, right? And the IV is only 39%. That's a smart entry right there. They're buying exposure before the hype. Hey, shout out to Don Juan 5400 for that follow. Welcome to the family. Welcome to the stream. Welcome to Degenomics 101, where we teach degen traders like ourselves how to trade like hedge funds and banks, basically. So think about this. They were buying this before the hype, 290s, right? Because they bought these on 1009 at 254. So we go look at Apple. So they took a little bit of a hit, but these are most likely starting to pay out now. And we're seeing Apple getting continuously upgraded. So the sheer volume and size of this alone should have gotten our attention about it, right? Agree or disagree? Yep. So this would be like a, hey, we should probably pay attention to this type of move. Good, 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 good. Good, good, good. So look at it like this. Sweep versus blocks, right? We already went over this. What's a sweep? That's going to be our urgent, wants in now market order. Hedge funds and fast money use that mainly. The block is going to be negotiated off exchange, and it's mainly used by institution. Yep, and they probably picked up on pullbacks as well. And then our blocks are institutions and fund managers. So blocks, quiet conviction. Sweeps are an urgent signal. Next up, sector and macro alignment. All right. Always cross-check flow against the macro narrative, right? So GLD calls, this is usually we'll see these when we see inflation going to tick up or rate cuts coming ahead. Okay. XLF calls, well, that means banks are anticipating higher spreads. The Eli Lilly calls, that is a confirmation into biotech momentum continuation. And Tesla plus SMH puts is risk hedging against the growth names, right? So that's the way you can look at it. So you're not going to necessarily sit here and go, well, I trade Tesla or I trade this. You want to trade the narrative that these companies have. And that's the important thing. And the nice part about flow data is it's going to show you what is heating up and what is worth looking at, right? So smart money versus dumb money, unusual flow, okay? So smart money, unusual flow. We're going to see size plus volume over open interest, right? We're going to look for expiration dates that are greater than 6 months. We're going to see IV control. We're going to see sector alignment as well. So if we see it in one, we're going to see it in the others, i.e. Tesla and SMH. And then dark pool confirmation. Yeah, sector. Do you want me to go over sector rotations next? No, so sector alignment means like how Tesla, if we see like growth names with puts being bought. So we're looking for all growth. If all growth names are getting hit with puts in a certain sector, then that's confirmation for that bias, basically. So like the Mag 7, for example, if we see puts being bought on Tesla, Apple, Microsoft, and the other companies that make that up, we can assume that the Mag 7 is planning to take a hit, and most likely tech is, and the S&P 500. And we would most likely see GLD calls and safe havens like defensive stocks start to get bought up, right? Does that make sense? Now, dumb money, unusual flow is going to play down. Yeah, sector alignment. Yeah, so sector alignment is different from sector rotation. Sector rotation means like people are no longer buying SPY, IWM, or SPY and QQQ, for example, and they're buying GLD, XLE, and utilities for instead. That would be considered a rotation, and you're going to see that more in the dark pools. And then you'll also see it in call buying across those stocks as well. Versus alignment, yeah, it's more seasonality, rebalancing. There's a lot that goes into rotations. Narrative changes from the central bank, narrative changes from geopolitical issues, whatever the case might be, right? So it's going to be more, yeah, no problem. So dumb money, unusual flow is usually going to be short dated, random ass strikes, sky high IV, no confirmation whatsoever, and it contradicts the sector trend. So it goes against the trend, and we don't want to fight the trend long term, right? Because again, this is for long-term unusual plays. So for example, Carvana weeklies with a 15% IV spike. Yeah, that's retail YOLOing. That's not them having conviction, right? So here's how you filter for quality flow on Investor Central Club. You filter for big money and unusual. You sort it by expiration, the longest first. Then what we're going to do is highlight positions with volume over open interest. So for example, Rocket Lab, $50 for 2028. Again, that would be a long-term hedge because we are 3 years out from that at this point. 2 years and some change. Track reoccurring names using the ticker history feature. So you can come up here. We can go, okay, let's see BA, for example. Yeah, we're not really seeing much for that. Let's go Tesla. I can't spell right now. So these are unusual big money plays, basically. And why are they unusual? Because, well, they're all long dated. And then we're going to overlay that with dark pool sentiment as well. So as we can see here, we're seeing people buy that Tesla up in this time frame. And that is going to correlate around when these trades were made, right? So on 9/16, we see 324 million spent, and then 9/17, we see $790 calls being bought for 2027. Do you see that correlation? Is that making sense to everybody? Go ahead, drop your favorite emoji from our thing in the chat if that makes sense to you or if we need to go over that in a little more detail. So now, when you see big, so the goal basically isn't to copy what whales are trading necessarily. It's to spot where the whales are quietly moving before the crowd notices, right? So we're not trying to copy these trades, but this is going to give us insight into where is the big money headed? Where are they planting themselves longer term? So, when you see big money flow, ask yourself this. Is it new or is this rolled up? I.e., is the volume greater than the open interest? Is it short term or is it a long conviction play? Exactly. So like a lot of people will just be like, oh, well, this just seems like a good trade to take, right? Like people will watch flow come in and out all day and they'll just be like, oh, well, I saw this unusual play today for Tesla or for Google. Let's hop in. Yeah. The Tesla one would be a hedge. Because again, you want to pay attention to the expiration date. So if it's usually 6 months to a year plus out, that's a hedge against a larger position that they most likely have. Yep, SOC. That's another example. So this is like, essentially, this could be looked at as accumulation, right? And these are all automatically executed, meaning most likely, but that IV is pretty high. That is the only thing that would make me nervous about it. But the reason the IV is high is this is a lot of money to be spent on a stock this price. Yeah. You have to kind of use like your own best judgment. Because, for example, in our Tesla example, this just doesn't make sense. 370 puts being bought, 38 million dropped, and it's 2 years out. I would do big money and unusual because, again, we want to see fresh positions, and that's where you're going to see volume greater than open interest. Let's dive a little more into hedging versus positioning. And the last thing, by the way, is you want to confirm by dark pools. If the answer checks all the boxes, that means this is smart money flow. If it's weeklies with high IV and hype tickers, that's just retail bullshit noise that you don't really need to pay attention to, because that's what ends up getting people burned most times. Because guess who's going to end up holding the bag 9 times out of 10 in retail? Any questions? Go ahead, drop them in the chat. Now I'll give you guys a couple minutes. What do you use for a news service, and how much is this Investor Central? So if you use the code Eric Loves Stacks, or Eru Loves Stacks, I think is the promo code that we have right now. Someone correct me if I'm wrong on that. You can go ahead and sign up. It is, here's the, and I just use Yahoo Finance, or I literally just Google stock news, basically. So here's our memberships. You can go ahead and take a look at these. Yeah, Twitter's pretty good too, because they'll also like post links to the articles, so you can just go and read them as well. Yeah, I agree. I agree. So do we want to go a little deeper? Do we want to do a deeper dive into hedging versus positioning? Okay. So, hedging, think of it as insurance. It's like buying fire insurance on your house. You don't want the fire, but you sleep better if it happens, right? Now, the purpose. Oh, no, I'm not that tired. I'm good. I can still go. I can still go. So what are the purposes of a hedge, right? Well, protect a portfolio or stock holding. A fund longs $1 billion. Oh, you're all good, dude. So basically, think of a fund buying. Apple buys 50 million, 1 billion in Apple buys, so like of common stock, right? And then they buy 50 million in Apple puts. Usually those are going to be short dated, 1 to 3 months, and they're going to be deep out of the money and a large size. So again, this Tesla example would be one of those, right? Now, it also gives them lower portfolio volatility. SPY, QQQ, IWM puts across different expiration dates. We all see that pretty often when we're watching flow on stream, right? We'll always see these random, like, essentially orders come in on SPY, even though it's having an up day, but we'll see essentially 1 to 3 month out hedges because we'll see short side puts that are pretty crazy out of the money, like 637, for example, is a strike I've been seeing a lot lately. High IV, and these are often going to be blocks and sweeps during rallies. So again, like I mentioned, It's like when we see SPY rallying, but then we're still seeing puts being bought and golden sweeps for puts being bought. We can think of those as hedges, right? And again, that's to lower the portfolio volatility. And then also expressing caution before events. Think about buying SPY puts before CPI or FOMC. Usually fade if data comes in soft, right? Smart money hedges when everyone is being euphoric. It's not bearish, it's just being disciplined. That's the easiest way to think about it. Cool? Now, what is a position? Well, positioning is equal to conviction in this case. This is when an institution is building exposure they want to hold because they expect value to increase, right? So this is going to express long-term bullish or bearish thesis. Think 2026 NVIDIA $1,000 calls and 2026 Oxy $60 puts. There's 6 to 24 months out, right? They're 10 to 20% out of the money, and they're going to have a moderate IV. And we're just using fake numbers for this, by the way. Now, we're going to align this with the macro trend as well. So think about it like our AI chips, the meta that everyone's playing right now, is energy, our defensive stocks. You're looking for the theme, and then you're essentially aligning that with the macro trend, and then you're going to look for orders within that trend, right? The typical traits of this will be repeated blocks on rolling flow. So meaning like we're going to see the same blocks. We're going to see block orders on rolling flow, meaning we're going to see flow that rolls in with strikes kind of around each other and expiration dates kind of around each other. Usually within 1 to 3 months of each other, right? And then seek leverage on growth is the final purpose. Leaps calls on leaders. Think Meta and Tesla. So when you see those leaps come in on Meta and Tesla that are long dated, typically we're going to see stable IV, and the price tracks the stock trend as well. So they might be out of the money, but it is a place where analysts have said price can go, or have a target for, or whatever the case might be, right? Like IBM would be a long-term play for me. I have a price in mind of 300. I've had that price in mind since December of last year, and my year target was 300. My 5-year target is 400 to 500. As an example, right? Making sense so far? Okay, perfect. Perfect. Let's continue. So think about it like this. When you see the same ticker, all right, good night. AMD, same thesis, exactly. Good night, loaded. So think about it, when you see this same ticker lighting up for months on end, that's not a hedge at that point. That's conviction money parking its money, basically. So you can look at that as, okay, this is where smart money is parking itself for the time being. Now, how can we tell hedging versus positioning in Investor Central Club flow? Well, the expiration date on hedging, it's going to be short term. We're going to look at less than 3 months. Positioning is going to be long term, 6 to 24 months out. The strike is typically going to be far out of the money, and it's going to be a defensive play. And positioning is going to be near or essentially on the money. So it's a directional play. It's showing clear direction, right? For the IV behavior, in a hedge, we're going to see rising fast IV, which is equivalent to a fear spike, and that's why we're seeing that hedge take place, right? But in positioning, IV is going to pretty much sit flat, which shows confidence, aka conviction in that position. For the flow type, think hedging blocks, we would see blocks on SPY/QQQ, right? On positioning, we're going to see repeated sweeps on specific names. Volume versus open interest. In hedging, high volume before events, and then that volume is going to close down after. Positioning, we're going to see open interest building over weeks at a time, okay? And then finally, the dark pools. These are going to be where we see outflows from sectors and inflows into those same names, right? So if SPY puts and NVIDIA calls are being print together, this is an example, right? So if we see SPY puts and NVIDIA calls getting printed at the same time, that's a rotational hedge. And then if NVIDIA calls print for 3 weeks straight, that is where you see positioning being built and where money is getting parked. Does that make sense? By the way, go ahead. Drop something in the chat to let me know you're still here. Yeah, so typically they will, right? But then what you're looking for is continuation buying. Exactly. Like going long on a stock like NVIDIA, but then going short on an ETF like SPY, right? That's what we would call a rotational hedge. But then if we continue to see NVIDIA calls getting pumped in for weeks on end, then that just shows they were building a position in NVIDIA on that rotational hedge. Perfect. I'm glad that makes sense. Now, section 4. Real world example. Let's use a real world example here, right? So that Tesla, think about it like this. 38 million. This is a multi-year with low relative IV for this ticker, because we usually see high IV within Tesla, right? This is a portfolio hedge. It's a long fund protecting Tesla exposure that they probably have a lot more money in, right? So 38 million to them, they might have a $380 million position. That's not that much when you think about it for long-term protection in insurance. Again, this Tesla put is fire insurance for your house. You may not need it, but if the fire does happen, you'll be happy you had it, right? Okay, so IV is just implied volatility, right? So hold on, we went over this earlier. I gotta go back to my notes. So IV is basically implied volatility, right? I want to see if I can find, I have a breakdown of it. So think about implied volatility as the market's prediction of future movement, right? It's like the fear gauge essentially baked into options price. So this is just, think of as implied volatility as like, how fearful are these people? High IV, that just is going to tell you everybody expects chaos. Like, the British are coming, right? Low IV, that is a calm seas environment where low moves are expected. So when you buy or sell options, basically, you're not just betting direction, you're also betting how wild are things actually going to get. So the levels of IV, 0 to 25% implied volatility is a signal for a calm market in that option, right? Premium is cheap and IV sellers are going to be quiet. 25 to 50%, that's normal. Like, that's the normal range. Standard flow, no real panic. 50 to 75%, that's a little bit elevated. Traders are now pricing in movement for that stock. And then 75 to 100%, that's high IV. And we're talking 100% plus because we saw beyond with like 795% IV, right? This means the market expects a big move and the premiums are going to be a little more expensive. So rule of thumb, anything above 70 to 75% IV rank is typically going to be a high IV environment, okay? Now you're probably wondering, why do IV crushes happen, right? That would be your next question. Well, after big events, think earnings, CPI, Fed decisions, once the uncertainty is gone, that IV drops like a rock. Even if you were right on direction, your option loses value because, well, the volatility in it deflated. So high IV is like buying insurance during a hurricane, right? It's expensive, but everyone's scared. But once the storm passes, the insurance is pretty much worth nothing at that point. So are you good on IV? Want me to go in a little deeper on that? Let me know. Injected in my veins. Yeah, no problem. But if hedges are typically shorter term. Yeah, in theory they could, and that's why you need to understand, like, why are you personally getting into the trade? Because that hedge might not last very long, and that's why you track the open interest on those trades as well. And yeah, that is where gamma is going to come into play. Gamma exposure and all that kind of stuff. But again, this is why you also need to track that open interest every morning the following day, because if open interest is steadily increasing, that shows more conviction. But if you see it kind of stalling out or start to sell off, you can tell that the whale or person you're tracking is most likely scaling off at that point. So when you see open interest drop, think of it as scaling out. When you think of open interest rising, they're scaling in. Does that make sense? So you're right, but that's where one day you'll see like the open interest just fall off the face of the earth, right? And then all of a sudden everyone's like, where'd the whale go? Well, they left because that position is more of a risk to them at this point. But then if we see open interest steadily increasing over time, that means that we can see conviction in their position. For the hedges, it's exactly that. It's a hedge. But again, that's why we're tracking that open interest. So the next example we have are these Google 116-2026 280 calls with 12 million in a premium. The IV's at 30, only at 35% on these, and they're long dated because we're out to 116-2026 and these were bought in the beginning of the month. This is position, okay? Institutions accumulating that AI exposure. And we saw what has happened with Google this month. Then another one would be the SPY 11/21/565 puts, right? We had 11 million dumped into these. Volume well above open interest, and it's short term. So this is most likely a hedge, right? Because based on what we know in hedging versus positioning, hedging, what are we looking for? We're looking for short dated, aggressive, out of the money positions. And mind you, the IV is only sitting at 27% here. And the final example would be FSLR. If I can find them. Oh, here we go. FSLR. We have 121. I mean, that's where you have to understand what kind of size. 11 million could be a drop in the bucket for them, Jim. Or they believe that we could see a very aggressive drop after this rate cut that we're going to get delivered soon. But that's also why this is marked as unusual, right? I mean, they bought 100,000 contracts. Yeah, I know. Yes, so this is a hedge. Because SPY's in an uptrend. This was bought on the 2nd. There's 100,000 open. There's 100,000 against 18,000 open interest, which shows it's a fresh position. It's short dated. So this is most likely a hedge to decrease their exposure in a SPY position that they have. Now for the FSLR play, this would be playing into a theme of green energy, because we also have multiple years on this with it not expiring until January 21st, 2028. So think about it as position building into a sector rotation play. So how do we confirm this stuff? Well, check the flow timeline. We compare the IV trend. Spiking equals fear. Flat equals conviction. Look for dark pool support. Accumulation means they're holding stock as well. And then also cross-reference your macro calendar. So if hedge flow spikes before CPI or earnings, expect a reversal after. So funds don't choose one, they balance both in this case. They buy what they love and they hedge what they fear. Example, we have long NVIDIA January 2026 calls. That is buying a position, right? Long QQQ November puts, well, that's a hedge because we're in October right now. And 1 to 3 months is typically the time frame we're looking for, right? For a hedge. And it's going to play against the trend in a sense. So they're building a position in NVIDIA and their insurance policy is through QQQ with short dated puts to minimize their exposure. Does that make sense? Hey, thank you, GQ. So think about it like this. If the AI sector runs, but the market dips, they're still going to win either way. They aren't taking a loss on that trade when it's all said and done. They win in both ways because AI is going to continue to rip up. Those QQQ puts might see a little bit of downward action overall because, well, there's some other stuff that holds the market up as well. But if NVIDIA gets good news, then most likely we'll see a print. So they win both ways in that case, right? So for all you degens out there, if you're trading flow intraday, follow hedges for momentum plays. And if you're building portfolios, mirror positions for macro themes. Okay? Hedges expire, but positions are the areas where we can compound. So think about it like this. Next time you see a $20 million SPY put or a $15 million Google call, ask yourself, is this fear or is this faith? Is this insurance or is this belief? That's the difference between trading options and investing options. Okay? Oh, thank you, Super Gal. It was a fun class today for sure. Hey, shout out to Super Gal for the 100 bits. Let's go. This class will be uploaded to YouTube, by the way. Yeah, no problem. I will be uploading this to YouTube. It'll also be, if you notice, on our Twitch page now. All of our broadcasts are being reposted. I'm making sure those get posted so people can go back and watch flow for the day and that kind of stuff. What else? What other announcements? Anybody have more questions? I'm hanging out for a little longer, so we have 873 followers now. We're 27 follows away from 900. We're 6 subs away from our sub goal. Yep, almost 888. Only 15 away from that. We are almost at 888. Ooh, I like that. So when they place hedges, is it a slight indication they might be thinking of a shorter term bias, or is it purely just risk exposure? I was thinking they only have hedges for a certain period of time. It might be the former. Yeah, it might be just like on a short term bias. Like, for example, if they think there's a catalyst that could tank the market, they're going to buy hedges. They're going to hedge against their open position, right? So they'll most likely buy out of the money, short dated puts for downside protection against a much bigger position. So it's just limiting their exposure, because then if the stock goes down, well, that gets paid out. So they make money either way. So it's just a way to like protect their capital and limit their exposure in a potential in playing into potential volatility. Because you'll notice a lot of hedges will land during like volatile dates, i.e. macroeconomic data, that kind of stuff. Because with funds, it's all about limiting their exposure for the most upside potential, right? Because they're playing the long game. They're playing the 5-year plan. They're not playing 6 months out. But if they can limit that exposure quarter over quarter, why wouldn't you do it? And a typical quarter is 3 months. So that's why I look for 1 to 3 months, because it's a hedge into that quarter, basically. Positioning, we'll see similar strikes, similar date. Could you search AMD? I'm curious to see if there was any signaling in the recent move with its current strength. Okay, so we'll look at AMD starting in October. We'll see if there's anything unusual that came through. Yep, so we had some unusual AMDs come in during 10-8, right? So let's do this. Like, I don't need to show you guys the full flow. I can, like, kind of split the screen at this point. So if we look at, let's say, the hour chart. Oh. So they bought on the 8th. Oh, I don't need this. So they bought October 8th at about 9:57, right? So they bought in at about this point right here. Okay? So we see 250s. So we see long terms, right? So this is position building, 450s for 6/18/2026, right? And then we also see more conviction being built because we also see 250s being bought for 10/24. So this week. So as we can see, it has been respecting this trend line, or it's been respecting its support, and they're most likely waiting for a break above 244. Or they could have played from here up and gotten out already. That's where you would want to go look at the open interest in those positions to see what's going on, right? Is the open interest increasing? Is it decreasing? And then if we look at big money, we can see 450s, 230s, 230s. We had 230s bought on 10-6. So people started to build positions right about here. Yep, exactly. If the open interest continues to increase, what does that tell you? What do you think that tells you when you see open interest increasing? Exactly. And then if we see open interest sharply drop, we can assume that they got out, right? Exactly. No. No. You're going to typically see open interest greater. You're going to see volume be greater than open interest. That's how you know it's a fresh position. If the open interest is higher than the volume, then that's most likely a position that they're building into. Or are rolling into, you know? So volume over open interest equals a fresh position. Open interest over volume equals something that is being rolled into or already adding into an existing position. No, you're fine. You're fine. I just need a minute to digest this. Oblivious as to how much money you would have to put in to actually potentially mess up contract prices. So, okay. Let's imagine you're bullish on Tesla, right? And you're planning to grab calls. And then all of a sudden you see a fund just drop 10 million on Tesla, 2026 $500 calls, for example. Here's what's happening under the hood. Hedge funds aren't just going to market buy $10 million like retail. Their orders get broken into smaller fills by execution algorithms. Think brokers like Citadel, Virtue, or JPM, right? That flow hits multiple exchanges at once, and that's what we call a sweep in this case. Okay? The sheer size of the order increases implied in volatility for that contract because the market maker now has to hedge aggressively. So the effect when IV rises, premiums go up, meaning your calls just got more expensive. If you buy right after, you're paying the quote unquote smart money premium, i.e., you're late to the party in this case, right? So let's say that $10 million, and this is why big buys can ruin fills, by the way. So let's say that same $10 million buy drives IV from 35% to 45%. Even if the underlying stock hasn't moved yet, the option price will spike instantly due to Vega. Think sensitivity to volatility, basically. So yes, when whales buy aggressively, it does make it harder for you to get a good fill, especially on thinly traded contracts. Think of it like this. When a hedge fund buys 10 million in options, it's like someone buying 100,000 tickets to a concert. The resale price goes up almost instantly, right?
Or if you try to buy like rare sneakers that get sold out right away. What happens when you see those sneakers, see that they're sold out, and you go to the resale market? You see insane prices for them, right? Exactly. So, what do you do instead? Right? That's your next question. And if you see massive bullish flow and you agree with the thesis, don't chase that same contract. You have three options here. For the most part, yes, because they'll have automatic algorithms that buy at certain levels and will trigger them to buy into positions. That's why you'll see like automatic execution on a sweep, because they had a price target set and then they deployed that much cash once that level was hit. Does that make sense? No, you're fine. You're fine. So you have three options, though, in this case. And this is kind of how you can minimize your risk as an investor. So, example, if the flow hits Tesla, January 2026 contracts, well, then check 290 calls or 310 calls or even April 2026 $300 calls. Funds usually go for liquid strikes. The neighboring contracts often lag in IV, giving you a cheaper entry before they get normalized as time goes on, right? Think of it like sitting next to the whale, not on top of it in this case. Then we have waiting for IV to cool off. That's number two for your option. Options IV often spikes for 15 to 60 minutes after a big flow hit. If price action doesn't confirm it, i.e. the stock doesn't move much, well, IV drifts lower again, and that's your entry window. Okay? And then finally, follow the hedges, not the print. Funds often scale into trades like this. So if you see flow building over several days, your goal isn't to front run the first trade, it's to ride the accumulation trend. The second and third rounds of flow usually confirm that conviction, not just a test order, right? Now, on the selling side of things, to answer your second part of your question, I'm not a good person, bruh. If you hold calls and see massive institutional buying coming in behind you, that's actually good. It's going to provide you more liquidity. But there's a catch. You'll get better fills if you sell into that demand. IV inflated equals a higher premium. If you wait too long and the order flow cools off, IV compresses and your premiums now are going to drop. So yes, ideally you want to sell into strength and not after it. That's why pros often fade the frenzy, because when everyone's chasing calls, they're unloading them into inflated IV. Now, think about it like this. Hedge fund buys 10 million in calls. What happens? IV spikes and the premiums go up. So what is the smart move here? Good night, super gal. You're going to wait for IV to cool down or pick an alternate strike. If hedge funds are selling heavy calls, Well, look for IV to drop aggressively and pick up some cheap premiums. Don't panic sell here. That's often a hedging unwind. That's the way to look at it, right? Now, if you're long on calls and you see huge new call flow, well, IV is going to reinflate, right? So scale out while liquidity is still high, so you're not left there holding the bag like most retail traders will be. And then finally, if you're bearish and you see a whale call buying, that means market sentiment is shifting. Don't fight it and go ahead and reassess your thesis at that point. Maybe you need to go longer. Maybe you need to go and play the trend for a little bit to make up for some of those losses. And maybe you hedge to the upside, right? You can keep your original position in your original thesis, but maybe it's time for you to hedge the reverse of your portfolio. Does that make sense? Exactly. You would want to either wait for IV to cool off, which usually happens within 15 minutes to an hour, as mentioned, and then, or you go and look for another strike that has a good amount of open interest in it, because that means dealers are already expecting price to move in that direction at some point. Perfect. So bottom line here, or here's some market maker hedging. When a big fund buys 10 million in calls, the market maker sells those calls. Short options equals a short delta, basically. To stay neutral, they buy the underlying stock, which creates upward pressure, and this mechanical hedging can temporarily push the stock up. Another reason why prices will spike post flow, because they're not only buying 10 million in that option, they're going to also go and buy the underlying equity as well, right? But this move can reverse if the dealer unwinds its hedges later, especially when that IV starts to come down, and that's where the term IV crush comes in. So big flow isn't just a signal, it can also cause short-term moves. That's why understanding the timing around entries and exit is key. The bottom line here is hedge funds can affect fills by inflating IV, basically. Don't chase it right away. Let the market digest the order. If you're selling, use high IV periods to exit profitably. Be aware that smart money trades in waves and not in single prints either. When whales splash, the water moves. But smart traders don't jump in right behind them. They wait for the tide to settle first, and then they'll ride that current out. Okay? And that is what would happen if someone bought $10 million in calls, and what happens to the market when those kind of events occur. Yeah, no problem. All right. I think that's everything, guys. I think we did it. I think we did it. We done did it, and we did it good. I'm 35. Thank you, GQ.
Thank you for that. Yeah, I'm only 35. I agree. Tonight was a very good class. Yeah, I mean, I think that's like where a lot of people fail is they'll be like, but I followed a $2 million SPY print. Hey, shout out to Jim for the subscription there. That's 25 subscribers now. Let's fucking go. But yeah, a lot of people will be confused. Perfect. But a lot of people will be confused, like, a lot of people will be confused as to why like that position might lose, and it's like because they only spent 2 million and they probably have like 15 to 16 to 20 million in equity, so they're just hedging against downside to minimize their risk, and that's the easiest way to think about it, right? Exactly. So if you like, one thing I always tell people when they're like, well, how do you know you want to get into a position? I'm like, because I have like a plan and a thesis that I want to play out. And if that thesis doesn't go according to plan, then it's easy for me to exit because, well, I have a thesis, right? I'm not sitting there blindly and just like hoping and praying it works out. And then it's also just once you have that thesis, it starts to allow you to focus in on flow. It allows you to focus in on flow with what's going on and stuff like that, you know? But yeah, I'll try to do these classes like twice a week. And then I let you guys pick the topic and I'll kind of put it together for you. And then good, good. I hope it helps. I really do. I really do hope this stuff helps you guys out because it's one thing I really do enjoy doing is like seeing you guys be able to like make money. Like that's more fun for me than me trading, to be honest. Is like being able to see you guys make money and like profit on stream from just like us being together, basically. So it's a great way for us to kind of like collaborate. And then it also kind of gives you guys a live view of how I find plays, how I chart stuff out. Yeah, I mean, hey, that's the goal. Is I really do want to do that. So, like that's my long-term plan is like every quarter we do well enough on this channel that I can give away a JDM car like once a quarter, so like 4 a year. And it would be like to a random subscriber on our Twitch. But we would need to be at like 200, 300 viewers at a time. We need to have like I'm going to have subscriber goals and all these goals that we'll have to hit in order for those giveaways to happen because obviously like I'll be paying for it out of my own pocket. And with the money that I get from doing this stuff, so it's a win-win. And then on top of that, I'm going to keep doing my options flow and day trading every day and that kind of stuff as well. The JDM car thing, that's been like an idea I've had for the past couple of years. Yeah, they do. Yeah, that's like highly encouraged, honestly. People come in all the time and like we'll figure out what people like levels for people and all that kind of stuff. I mean, if you were here today, you see like a lot of people said today that my SPY levels are the reason why they were able to stay in their calls for as long as they did. And we found the bottom and the top on top of that. So hey, I'm glad you found it too. Glad you found it too. And we have a Discord and yeah, it's time for us to wrap this up, fellas. Love talking to you guys. Love everybody that's been in here. Hey, no problem. Good night, everybody. I hope everybody has a great night. I'll see you guys. We'll probably have a shorter stream tomorrow. It's Friday and it's CPI, so pretty volatile events to trade into. Don't want to get anybody burnt. So see you guys in the morning. Have a good one. I'll see you next stream.